Welcome to TheoTrade. This is Don Kaufman. It's November 17th, 2018, and you are watching the TheoTrade Weekend Update. All right, another week goes by, some more volatility in the marketplace, and we like it. That's not necessarily because I happen to be longer-term bearish in the marketplace. This volatility is just creating trades. Listen, two-sided markets, that would be a buyer and a seller, is a very good thing. For those of you that know a little bit about gravity points, I mean, come on, how many times this week did you have to scream out 27.31 or better yet, 26.82? Those, again, relate to gravity points inside of the S&P futures. Now, on this video portion, I just want to raise a couple of key points to be able to create some trade ideas, and I'll show you a couple of trade ideas when we come over to the charts and to the trading application in just a moment. Let's get right down to it. Let's make a couple of points. Number one, capital rotations persist. What does that effectively mean? Capital rotations. You know, we've been seeing this for many, many months. It's like out of the financials into technology, out of technology into the financials. But now we're actually seeing, again, it feels like that kind of last gasp of hope. You know, what's being bought out there? And I'll just give you an idea. The emerging markets, okay? So the S&Ps net this week were down, okay? Emerging markets, though, were actually up. So all of a sudden, you're seeing capital come out of the S&Ps into emerging markets. Since when has the emerging markets been a good thing? All right, that's in bear market territory. But that's not it. And again, I'll show you a couple more capital rotations where if you can get ahead of these, right, you can create some really wonderful trades. Now, let's move on to part number two over here. Part number two, and some points that I want to raise, happens to be specific into what I call life raft stocks. What are some life raft stocks? What does that mean? Well, right now, it's tough to want to go out and to buy the bonds, right? Because we know that the Fed is going to be increasing rates. We know the Fed is trying to reduce the balance sheet. So there becomes life raft stocks. What are some of the life raft stocks? You got to look at stuff like Verizon and Merck and McDonald's. You know, McDonald's. It's the McRib season. We must buy McDonald's. You know, Procter & Gamble, J&J, Aetna, United Healthcare. I mean, I can go on for a long time on these fronts. These are better dividend paying, not necessarily high dividend paying, better dividend paying, but they're thought of to be, again, very protectionist, if you will, underlyings to purchase. And they are flying. And you got to look at stuff like Verizon, which we will in a minute here, where you're like, wait, this isn't like the latest, greatest tech stock. Like, you know, they're not reinventing the world over there, but the stock is flying up like you think they would. All right. The next and the third point that I want to make, okay, did the reports from NVIDIA, okay, and Applied Materials, does that bother you? And I'm just throwing that one out there, you know, maybe a little contentious, but now we're seeing reports of weakness. And, you know, I've been bearish again and looking for volatility for quite some time, but now we're getting definitive reports. The problem with that is the reports are coming out after the volatility and after the onset of volatility. You know, it's nothing like a day late and a dollar short. We've been telling you for months and months, okay, that 2018 was going to be met with some wild volatility. In fact, we called this entire year what we termed return of the trader. So we've seen reports now from the spectrum of stocks, everything from gaming stocks, okay, to major retailers, and now you're hearing it in technology. What bothers me about NVIDIA or Applied Materials is their connectivity, if you will, to all the other major areas in tech. It's that they have a hand, NVIDIA has a hand in so many different areas and so many different businesses in technology that it really does become disconcerting. With that, we're going to get into some very specific trade ideas. We're going to talk about expected move. Okay, we're going to look a little bit at the bond markets, and more appropriately, we're going to create a couple of trade ideas. With that, let's get to the charts. All right, let's do it. Let's get to the charts. With that, I was talking about the S&P futures just a few minutes ago, and we were looking at, again, what we kind of term specific gravity points. If you do not have these points, well, we can make them available to you. Again, this is in relation to the S&P futures. This can also, of course, be adapted to the spiders. It could be adapted to the SPX.
Down below here, we have 26.26. We have 26.82. We have 27.31. We have 28.11. These are very definitive gravity points based on risk amongst mass trading firms. Effectively, what it means, it's kind of a stopping point. Do not think of this per se as support and resistance, but points along the way that the market happens to effectively be drawn to. With that, let's get right down to it, and let's start to talk about some specifics, and then we're going to get into some trade ideas. The first thing that I want to start with on this kind of, really looking at the charts and some option chains happens to be the expected moves because, it's incredibly important because, hey, listen, this is what's driving the marketplace. Now, we talk about expected moves. There's a lot of conversation, how these things are created. Listen, the expected moves, okay, are just denoted by the option premium, which I'll show you here in just a moment. But the expected move for this previous week, this is the week that we just passed through that was, fairly volatile, right? The expected move was right around $49. Okay, so that means we're supposed to move about $49 higher or $49 lower. And the irony of that, right? The central point, that's the central point. That's the start to the week. This is the upper end of the expected move. This is the lower end of the expected move. The upper end, of course, would be precisely $49 higher. The lower end is, precisely $49 lower. So that's the starting point. Right out of the gate this past week, we see a breach of expected move, which is just hideous to begin the week with. We actually breach a little further. We're looking at like crazy, possibly 3 sigma territory. That's 3 times outside the deviation. All of a sudden, we're going for it, and we rip right back to it on the button, people. Like if you laid a butterfly in the SPX at 2730, that thing is golden. And the reason I'm bringing this up is like, how many weeks in a row do we have to edge right to the expected move for people to realize this is what's driving markets? Like, and that's the point to be made over here. Now, this coming week, what do we have for an expected move? So again, last week we saw right around a $49 expected move. This coming week, we're sitting on about a $47 expected move. Man, okay, so the expected move, Don, is less. Is it? Is the expected move less? Well, yes, but then you have to recognize that we're actually coming into a holiday week. And that's the point that this is kind of interesting. It's a holiday week. Thanksgiving, turkey time. So we're closed on Thursday. So we're going to have Monday for a trading session. We'll have Tuesday for a trading session. We'll have Wednesday. But everybody kind of bails like Wednesday afternoon. Okay, heads for the airplane and goes for a turkey, wherever that may be. We are closed on Thursday. And then we have a half a session on Friday. That's, of course, Black Friday. So you got 3.5 trading sessions. But what are we seeing? It's a $47 expected move. And that's important, which actually, entitles us to say it's going to be a fairly volatile week. I mean, come on. The expected move is almost as big as it was in the previous week. Now, in the midst of volatility, and I'll always say this, in the midst of volatility, go back to your levels inside of the S&P, okay? You can't be predictive in nature. I'm not going to sit here and tell you like, I think we're going to go up this week. I think we're going to go down this week. No. What I know is we're going to ping from level to level. That could mean a shot straight up to 28.11. That could be a shot straight down to 26.26, okay? You have to just be aware in volatility. Forget about any degree of predictive nature other than the fact that volatility kind of does entail a much more bearish connotation, if you will, to the entire marketplace. So net, over the duration, do I believe we're going lower? Yeah. But guess what? Along the way, we're going to make some stops higher. You can pull off some great bullish trades, some great bearish trades. Now, with that, let's get to a couple of really specific points. So down to it into the marketplace. An area of talking about a tremendous amount. I've been talking about it. Corey Rosenblum's been talking about it. Jeff Bierman's been talking about it. I mean, almost everybody here at TheoTrade. We're looking at the financials because the financials have really, these things have become the linchpin for the entire marketplace. And I've mentioned this time and again, but 2650, okay? It is our Maginot line. Below it, the S&Ps themselves become hideously bearish. Above it, well, then we rally for the time being. And you got to look at this close because we're just hovering in and around it. All right. It's a very, very fine line. And the reason I'm bringing up the financials right now is because, well, I was a little bit perplexed by this trade. And, that's one thing as a trader that I think that keeps me involved in this business all these years is that, you've seen a lot of crazy stuff and, been in this business now for over 20 years. See a lot of crazy stuff, but here's the bonds ripping higher. Okay, here's the bonds ripping higher. And lately, the financials, they've been incredibly sensitive to any movement in bonds and in interest rates. So the bonds actually rip in the last couple of trading sessions from 137. I mean, we're a straight shot now, almost to 140. That's a 3-point move up in the bonds. What have the financials done in the exact same time frame? They're not reacting. Specifically to yesterday. So the bonds were up yesterday. Did the financials sell off? No. Okay. It's the marketplace itself is turning a blind eye. But one thing that does kind of stand out, all right, the range isn't huge, for example, for yesterday, but the amount of volume, it's a real standout. There is monstrous positioning going on inside of the financials right now. And I'm telling you, you better pay attention to this real soon because the kind of volume we're seeing, it just doesn't seem to kind of, jive with a 3-penny move inside of the financials themselves. Not to mention that yesterday, they didn't do anything. They rallied out of the gate and they just didn't do anything. And the volume is absolutely immense in there. So an area that I'm a little perplexed in, but you have to look at that 2650 level inside of those financials. Now, let's start to get down to some of the trade ideas. So I raised a point in the video section over here of what I talk about capital rotations persist. For that, I'm going to kind of cruise over to, this is the Market Watch under the Visualize. It's just an advanced decline line. The first thing that I want to tell you about the advanced decline line is simply this. And again, I'm looking at the S&P 100. I don't need no stinking S&P 500. I got the S&P 100. All you're looking at, it's the 100 stocks. Why? Because it's 100 stocks that move the market. The advanced decline line is a veritable slop fest, which it should be. When the S&Ps are up 7, the Nasdaq is down 18, the Russell's basically unchanged. The Dow was actually the leader on the day. So the advanced decline line is a mess. But even in a big up day or conversely a big down day, the advanced decline line has still been rather a mess. This is disconcerting. It's very, very disconcerting. We're not seeing correlation. We're not seeing correlated states. And I've mentioned this again previously, but it really, looms large. You want to see, like in a down day, you want to see, like 10 stocks up, 90 stocks down. In an up day, you want to see something similar. You got to get correlated. Why do you have to get correlated? Because otherwise, you're just playing musical chairs. And musical chairs doesn't stop in a marketplace. When I say musical chairs, again, I'm talking about like, let's get out of the financials and let's get into tech and let's get out of tech and into financials. And, well, you know what? Forget it. Let's just shift over into into energy, or let's just whack energy and then move over into healthcare. And we're seeing this constant musical chairs. And as I said, the game of musical chairs is the capital rotation. When the music stops, you'll know it. It'll be correlated. And when it gets correlated, then, and only then, can the market get ugly. Why is that important? It's important. You got to get ugly before any of this is going to end. Otherwise, it's not going to. All we're going to see is, again, it's this game of whack-a-mole in the market. This sector pops up, whack it back down. Which, again, kind of brings me to the point of these what we term life raft stocks. So I'm going to close up this left side bar. We're going to go through a gamut of a couple of stocks when I talk about like life raft stocks, because these are heavily involved in the capital rotation. Again, this is Verizon. Let's throw up a year-to-date percentage, just make a few points. So, as we look at this, they're up. Verizon's up some 13%. However, you can even look over like a 3-year period. It's up 33% over a 3-year period. But the most recent jump to the upside, I mean, it's a straight shot up. And I talk about a life raft because when the volatility really kicked into the marketplace, everybody get into the boat. What is it? It's the Verizon boat. And again, it's a little disconcerting. It really popped to the upside. So it's up 12%, but the entire 12% gain has come in what? The last month of trade. And again, it's an incredibly fast move. The next one, and you guys could probably make fundamental arguments. Well, Merck is a really good company. Really? Is it 35%? Okay, because the last time, like, again, they're not reinventing the world out there. But again, you can make some fundamental arguments, right? You're going to make some fundamental arguments for Mickey D's. McDonald's. I've actually got some positions on McDonald's. I have a short position on McDonald's. How's that working? Not so good with this burst up. I actually entered a short position right in here on November 12th, and here we currently are. I kind of like my odds, right? I mean, listen, this thing, it's going to come down eventually. But when I talk about, ideas in terms of trades, yeah, well, here's one right now. It's McDonald's. And again, all of a sudden everybody realizes like, hey, maybe I should turn around and buy McDonald's. How do you think McDonald's is going to turn out? Maybe it's going to look like something like Walmart, because we saw the exact same thing. Listen, this was a Life Raft stock, and I talked about it, okay, being that just about 2 weeks ago, everybody in the world like, oh, we have to buy Walmart. In fact, we were poking fun at it. This is 1, 2, 3, 4, 5 trading days, decimated this week. In fact, we even talked about it last week on the weekend video, being one of these quote unquote Life Raft stocks. Okay. So that's why I'm effectively bringing it up. So there's McDonald's, there's Merck, there's Verizon. Okay. Of course, we could look at something like, Procter Gamble. So how exciting is this stock? Not so much, but they're buying it like it's going out of style. Now, granted, this one I'm not so, into the idea of shorting into. It's only up 3% on the year. But you can look at stocks like J&J, all right, which has rallied up substantially. We can go on and on. One of the areas that I think you should also consider would have to be healthcare. Healthcare, these, again, it's been the Life Raft. And not a lot of people necessarily are looking at healthcare as the Life Raft. But Aetna, up 15%. And again, they're moving like they're tech stocks. And most of these have relatively low beta, which means, well, effectively, they shouldn't necessarily be moving like that. And again, there's going to be some great opportunities on this front. Let me get really detailed and really specific. I've brought up a lot recently in terms of retailers. Now, this happens to be the XRT. This is actually a retail ETF. And I've been short in and out of the, short positions in the retail ETF a considerable amount. But I've been hammering on the idea, okay, of retail now for weeks and weeks and weeks. All right. Why? First of all, listen to the Fed. We're in a rising interest rate environment. How's that going to fare for retail? Probably not so good. Again, I don't want to get into fundamentals. I don't want to get into like, well, but there's a fundamental reason. This is not about fundamentals. This is getting ahead of sectors. This is about quantitative finance. And what quantitative finance is doing is there's just systematically dismantling, okay, individual sectors based, okay, on, okay, some real data that happens to be out there. However, at the exact same time, if you see something like the retail sector, okay, and you're like, all right, I think the retail sector is going to tank, but it already has fallen. In this case, I'm not indicating that you should short the XRT. I'm already in a short position here, and quite frankly, it's working, but the chicken's done, right? Like, I'm not going to get into another retail sector position, here in the XRT. Now, we created positions recently inside of Macy's. This was a short position that we put on inside of Macy's. Again, its earnings came out. All right, it's getting its goose cooked a little bit, but it's still up 26%. Now, if Macy's were to bounce a little bit more, it might be another opportunity, okay, to get short. Now, why did we get short Macy's? Well, we looked at the liquidity of Nordstrom's. The liquidity of Nordstrom's was not there. Do I regret not being short Nordstrom's? No, not really. We're short Macy's, and we think that it'll probably fall to the same fate of something like Nordstrom's. But now, more importantly, where are you going to go? Where are you going to go? Okay. Now you got to start to think about like other retailers. And with that, I started looking at brands. Okay. So I looked at something like Ralph Lauren, which, sorry, it's already getting, beaten up. That ship has kind of, passed us by. Then I started looking at stuff like Nike. It was up 33%. It's up 17% right now. Come on, it's already lost half of its gains in the year. So again, that ship has kind of sailed a little bit on here. And again, we just kept going brand specific, okay, in terms of retail. Brought up Lulu. therein lies an opportunity. Yes, it's off of its high of 100%, but the thing is still up 70%. When's everybody going to wake up and start to whack this? I know, Christmas sales are coming. You know what? I don't think it's going to matter this year. Stock's up 70%. This isn't about loving or hating Lululemon, right? This is not about, Lululemon pants, okay? This is about the fact that this thing is up almost 70%, and it happens to belong to retail, and retail is getting tagged. It's only a matter of time before quantitative algorithms will actually turn and start to whack Lulu. How would I actually trade this? Well, they do have an earnings announcement coming up. So for the most part, I think you have to use more of a duration position where you have to go in there, you have to buy a deep in the money put. Okay. But Lulu, believe me, I'm shopping. Okay. And I don't mean shopping again for yoga pants. I'm shopping a bearish trade inside of there. Now, this idea again of kind of sector rotations, it leaves the door open to constant trade ideas, everything from in-out spreads, duration positions. Okay, another one that I think is absolutely still there. Okay, and this is, and you can see I've got a position in here. This is a bit more risk, if you will. It's Microsoft. Okay, and here's another one that really, kind of bothers me at this point. Microsoft's still up some 26%. It is completely and utterly unscathed. It's untouched. I like this stuff. All right. The reason I like this stuff. All right. Look at some of its peers that we term the monsters of tech. Want to look at Netflix? Netflix isn't really a quote unquote monsters of tech, but it's off from 100% year to date. Okay. 110%. It's only up 40%. Okay. Apple hit full blown, bear market territory. I bring up Facebook. Facebook, as I've said time and again, the beatings shall continue until morale improves. Look at that. The symbol doesn't even want to come up over here. Amazon. Amazon is suffering a hideous fate as well, although it's still up 34%. Okay. Now, I'm not saying that we couldn't see a year-end rally into something like an Amazon. Okay. But Google's flat on the year. Like this one is falling off everybody's radar screen right now. You have Google flat on the year. You got Facebook getting crushed on the year. What's holding us up? Yeah, Amazon's still up on a percentage basis, and Apple's still all right. It's up 12%, but Microsoft, it's unscathed. Okay, and I don't think it's going to remain unscathed. However, I think the best trade for it is to use a bit more of a duration position because we're not looking for a quick shot to the downside. Okay. We're looking for this thing to get pummeled by the tune of 10, 15, maybe 20% and end up in some of the same category as a few of the other techs that have gotten hammered recently. It's a lot to think about on this weekend's video. I'm going to be talking about and trading a lot of these different strategies. Specifically, I'm looking, of course, for that Lulu position, the Microsoft position. We're going to talk much more about the financials. We'll be looking at the retailers. I mean, listen, this is what we do here at TheoTrade, and there's plenty of opportunity, again, with these wild sector rotations. With that, thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.